Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the first trading week of October through the end of October 5, 2018. Sorry for my voice. Just been doing a lot of presentations and talking and working with traders at seminars and things like that, so my voice tends to get really low. Okay, let's take a look at what we got going on this week. Really interesting week. We've seen the 10-year interest rate move up pretty good, about 3.23%. 30 years up about 3.4. And as I always tell my members, I don't care if you're trading the bond market or not, or trading currencies or not. Following interest rates is a mandatory thing because wherever the interest rates go, which means wherever the bond market goes, that's where interest rates go, which affects currencies. And of course, the trickle down theory here is the equity market. So we've had over the past 30 years, I think we've had pretty much the biggest globalization ever. You know, China's come into the WTO. We've integrated world supply chains. Everything was kind of finely tuned and equally balanced. China, once they came into the WTO, started cheating a little bit to try and catch up with everybody else, taking technology and a few other things in widely documented cases, by the way. And I guess a lot of U.S. presidents hadn't really tried to do anything, but now Trump's coming in and he's trying to do something with China. Be that as it may, one of the things we got to take a look at is just, you remember 2017 was the year of globalization. All markets were moving strong, higher. Year 2018 started off with a bang to the downside, and then it's recovered everything and surpassed the 2018 highs. But the globalization story kind of just went and the U.S. now, I think we've reached a little bit of a stretch with the U.S. outperforming everybody else around the planet dramatically. And I've been telling our members that's going to come back in line. Okay, that will come back in line. We've had the Feds, which are now cutting back our balance sheet, the U.S. balance sheet, to the tune of $50 billion a month. So the U.S. government's got to raise about $1.3 trillion over the next 12 months, which means someone's got to buy those bonds, and it's probably going to be sovereign wealth funds, other current country treasuries, other country central banks, including some U.S. central banks. Excuse me. So that makes for a toxic cocktail. Excuse me. Just having a hell of a time with my mic this morning. Or maybe it's my voice. But I like to blame it on the mic. So we're seeing right now rising U.S. oil. The U.S. dollar's pulled back a little bit, but it's still relatively strong given all the other currencies. Bond yields which have been historically low, are now rising up. So generally when you have rising oil, dollar, and bond yields, that's really not been, history has shown it's not been a good combo for the equity markets. The other thing that I'm watching is the corporate debt market. If you look at the lower end of investment grade bonds right now across the country, basically rated triple B, BBB, right? A lot of them are going to be refinanced over the next 3 years. That's $6 trillion. In the lower end of the investment grade bond market due to be refinanced. And interest rates, should they go a lot higher, it's going to be very difficult for some of these companies to refinance, which means some of these companies are going to be downgraded. And it's going to impact corporate profits. Now, we've had great corporate profits. We've had a very strong economy. We still have a strong economy. We had unemployment come out this past week. And it's been the lowest since, 1969, 3.7%. We've got tame inflation. In fact, Power Ranger Powell, our Fed chair, basically said this is kind of like a Goldilocks economy. He didn't use the word Goldilocks, but he said this is it's really a great economy right now. But be careful for what you wish for, because I haven't seen in such a long time free markets. And I saw this also comment in Barron's, and the guy that made the comment, I agree with him 100%. We've moved from kind of like a free market system to a managed economy where all central banks after '08 and '09, when we had the big, huge recession and crash globally, just about every central bank in the world came out and started strong fiscal stimulus. The ECB was well behind the U.S. The U.S. kind of led the way with fiscal stimulus. We've cut it since 2015, which is when we had our first rate hike, going back to December Q4 of 2015. And then other central banks started doing their fiscal stimulus and cutting rate a little bit after the U.S. But now there's so much money that has to come off central bank balance sheets over the next, let's say, 3-4 years. No one really knows how it's going to work itself out. I've been telling our members that over the next 1 to 1.5, maybe 2 years, we're going to have a pretty good pullback. It's going to be a bear market kind of thing. Near term, I don't see it. I don't see a recession near term. Okay. What we're seeing right now is just a recalibration of forward PE ratios. Okay. There's only two things, as I said, that'll affect stock price. One is earnings per share. You've heard the term. Earnings is the profits is the mother's milk of prices. If you've got strong earnings, as a company, it's going to move your stock higher. In a bear market, when correlations go up almost to 100%, even good companies get cut. They get a good haircut. But we've got strong earnings, so that tends to raise PE ratios. That's why I said the PE ratio now is still lower than it was in January, when we had that huge run up in January. If you guys remember, PE ratio then was higher. But how can but I've said right now price action is, just slightly above where we were in January, but it's still higher, right? And yet PE ratios are lower. And the primary reason is because of strong corporate earnings this year. Unbelievable. Strong corporate growth, strong small business optimism, consumer optimism off the charts. Q3 earnings, while the forecast has come in a little bit, analysts haven't really peeled back some of their forecasts as much as companies' forward guidance. So we're going to kick it off this coming week with banks towards the end of the week. I think banks could be an overperformer. The bar for banks is so low right now. Remember, for the banks, it's all about the yield curve. The 10-year less the 2-year, if that's how you want to measure it, 2s over 10s. And as long as that yield curve keeps going down, then banks are going to suffer. But if it flattens and starts to go higher, banks, they borrow on the short term and then they lend on the long term, and that gives them their net interest profit margin, right? So as long as that's there, they'll do okay. So I think we've got a little bit ways longer to go with these markets. And this recalibration that we've seen over the past couple of weeks, and the market's pulling back a little bit, it's really, if you look at it on a weekly chart, I don't even think you can see the move on a weekly chart. Okay. We've seen the 10-year move over 3.2, as I said, the 30-year over 3.4. So what that does is, the second thing that affects stock prices is interest rates. So you've got earnings per share, profit, corporate profit via earnings per share, and you've got interest rates. Now, companies are not stupid. While interest rates have been this low, they borrowed like crazy. They're building up their balance sheet. So going into this next recession when it hits, and going into this next bear market when it hits, with this high corporate debt, companies now have much stronger balance sheets than we had in 2008, 2009. So that is on the plus side. But as you guys know, the markets now are run a little bit different than they were in '08. And what you're going to see the rise of since 2008 are passive index funds, where they just, they are not trying to find the best companies and the best sectors in the haystack. They're just buying the whole haystack, these passive index funds. And they've done very well for the past 10 years. But what we're going to see over the next 5 years, I think, those passive index funds are going to severely underperform. Because they buy everything. But then again, when they start getting redemptions and the market starts pulling back, they also sell everything, just like they buy everything. So you can't have it both ways. So that's going to cause both good and bad companies to pull back, but that's going to be a stock picker's market. And sector rotations are going to start to pick up a little bit, more so than what we've seen lately, right? Where everything just seems to go up. which is what's been driven by some of these passive index funds. So that's kind of where we're sitting right now. Interest rates are moving up a little bit. We're seeing a little bit of a recalibration of forward guidance. The bond market had only projected 3 more rate hikes through the end of 2019. The Feds, mind you, have forecasted 4. One coming in December of this year. There's still a 70% chance they're going to do it. And then 3 more in 2019. But the bond market is now maybe finally coming around more in alignment with Jerome Power Ranger Powell, our Fed chair, and saying, okay, well, if they're 4, let's do a recalibration. Where should the PE ratio be based on corporate profits and so forth, where they're going? Where do we want to take PEs? And by doing that, they reduce the markets. And that's what's happening right now. Okay. There's going to be a time when we've got a correlation between equity and bonds. You guys may not remember this, but in Q1 of this year, we had the bond market falling and the equity market falling at the same time. All right. That is unusual. Normally, when equity markets falling hard, money seeks safety via government debt. Okay. So equities go down, bonds go up, interest rates go down, right? Well, we didn't have that in Q1. It was one of the rare quarters where we've had a systematic, just let's take cash out of the market, period. There's going to be periods like that as well. Okay. So I just wanted to kind of point some of these highlights out for you. We got a lot of things sitting on the horizon that can upset this market. I think Q3 earnings, which we're kicking off this week, are going to be strong. They're not going to be as strong as we got in Q2 and Q1, but I think earnings are still going to be robust, but where everybody's going to be focused is on forward guidance. Okay. So that's why for our members, we do focus a lot on corporate debt. We do focus on yield curves. We focus on the bond market and interest rates, even if we don't trade them. We do, but for folks that don't want to trade them, we use them to help gauge where the equity markets are going. Now, what I've got on the screen here is the E-mini daily chart, S&P 500 futures. You can see this was right over here on the left-hand side, this was the highs made in January. And if I were to just kind of extend a bubble around that, right, that is a huge support zone for us. I mean, it's got a lot of things going on here. One, we've got the highs made in January of last year. 2, we got some very strong support right here in this slight pullback. And 3, we've got the 50 EMA sitting right there where the E-minis just bounced out of. And 4, we've got this upslope and trend line, okay? That goes back somewhere in the summer months when we started the big move up off of this big pullback that we had, back over here, okay? So we've got a lot of support here. So I'm going to watch this very closely. So defining the range, 28, 63, 91 to be exact. Excuse me, which kind of defines that pivot low right there. So if we, and again, I look at what the price is at settlement after the day close, not intraday, right? So intraday we could move below it, but I want to see where we go. If we blow through that and then we make an attempt at a retest and it fails and it comes back down, then I'm going to recalibrate, okay? And in that recalibration, you're going to see a range that I'll highlight on my chart should we get down there, right in that area right there, okay? And in that range right there, we've got pivot lows and pivot highs, a lot of them that supports the market there, okay? And we've got, at that point in time, as we're moving down, the 200 EMA will slowly start to flatten like that because the vector's going to start to change. So that'll be our drop dead right there. There's no, I don't want to say there's no way. I just don't see us getting down to this area. We could break this key area right here and stay in a chop zone while people sort things out in Q3. If the markets are satisfied with Q3 earnings and forward guidance, then you're going to see this area hold here. And we're going to kind of slowly do one of these things. I do believe, I am of the camp that over the next 5 years, the returns we're going to get in the S&P 500 are going to be nowhere where they've been over the past 5 years. No way. All right. That is the camp that I'm in. So what we're going to do as our members is we're going to change some of the structure, position structure of some of our longer term trades in using the option market and the futures market to play this out in a nice manner. So that's a little bit about what I'm seeing. I spent a little bit of time on this, but I think it's very important. You need to understand how this thing is starting to set up. If we look at the Dow, which has been on fire, right? I mean, if we look at the Dow futures, it was down about 151 points. But look at the elevation off the 50 EMA. Now, the Dow, it was the last to take out the January highs. Here was the January highs here. And if I extend it over, it's kind of like a line like that, right around 26,750. So the Dow was the last one really to take out the prior January highs. All of this was based on the idea and the assumption that, Trump is using these trade tariffs as a way, or the threat of trade tariffs, to bring people to the table. And so far it's worked. Mexico, Canada, now he's going to work on South Korea, Japan, Europe. And let's assume those work. That'll probably allow the Dow to make new all-time highs again. Okay? Probably allow that to happen. Then we've got the 50 EMA. We're well north of the 50 EMA on the Dow. So as a chart, the Dow futures now looks a lot stronger than the E-minis. And when was the last time you could say that? This longer term upslope and trend line, which goes back a ways, is also going to serve as a little bit of support. So we've got that area there. And like the E-minis, there is a support level underneath that, right? So if I were to kind of just bracket in the prior support area, it takes us right down to this area right here with 25,682 kind of in the center here. So, and if we look at the MACD, I'm just going to draw this line right here. There is no divergences in that MACD going back to almost the summertime, right? Normally when you get this porpoise move higher like this, right, you get some divergences in the MACD, and there are none. That just means money, really going all the way back to July, the middle of the summer here in the U.S. Money has been pouring into the markets really strong. And if I were to kind of like just draw a trend line, that's kind of a bow, but you can see here the vector of that trend line is very strong. And if we break it, we've got the 50 EMA and we got this longer term trend line to hold us up. So the Dow basically has got the strongest chart right now. And let's go look at NASDAQ, which was, very strong, right? And look at NASDAQ. I mean, this is kind of hard to imagine, but NASDAQ, look at the January highs on NASDAQ. They were right here, right? And if I were to extend a line over, look how far north we are of that. NASDAQ for the year has near term, Dow's got a very strong chart. Further term out, NASDAQ is much stronger, right? We made a new high there. We made a new high there, one there, and then one here. So we've had since January, 1, 2, 3, 4, 5 new highs before a little bit of a pullback. Okay. Really amazing. So we've had these pullbacks. Now, also, the other thing I want you to note here on NASDAQ is look at the 50 EMA, right? Really since May, when we came down and challenged and almost went into the red in the summer for NASDAQ. Since then, we haven't spent a lot of time below the 50 EMA. We've touched it a lot, but we haven't spent a lot of time below. So this is really another challenge, just like these challenges that we've had, with the 50 EMA here, and here, 4 other prior challenges. So one of the other things I want to leave you with in this session is the 50 EMA, which you can barely see it, has started to take a downward vector slope. All right. The 200 EMA is still robust. So I would look at the 200 EMA as going back to the January highs. And if I were to kind of like bracket this in, it would be a fairly wide bracket, but this would be my go, no go between the markets just totally capitulating. I don't see NASDAQ going that low. I want to watch this here. And like the other markets, we could pull back and then find ourselves inside a range like that. That's kind of what if we break down further next week, we could see that. And if we break down just like all the other markets and we come back to a retest and fail and it comes down, then that's where we're going. Look at that volume over price there. Huge right there. And then we got a huge volume over price right here. So this is kind of a no man's land as far as volume goes. So typically this volume over price shows where all the buyers and sellers were in fair value, sitting around 73.58. So I would call this a fair value area. So that is another key for NASDAQ. Now keep in mind, we have seen some sector rotation. All right, if we were to look at XLK here, which is the tech sector, you're seeing, I mean, the chart looks almost the same, right? And if I were to, just trend line this thing like this and just kind of trend line it out, let me just kind of do it like this, right? Like that, kind of trend line it. We broke that key trend line right there. Okay. I mean, we had that. I didn't include that bottom there because we closed up above. So if I was drawing just a line graph, you would see it would be like that. A line graph here. So this is the first break of the trend line going all the way back to April. So that's why it's key. Okay. And if I blow it up, you can see the slight curvature to the downside in the red line, which is the 50 EMA. Okay. So I wanted to point that out to you guys. We've got this situation coming up here on the on technology sector that does not look as good as I would like, and we've got that divergence sitting up here. So we could have some more sell-off in the tech sector before things kind of get back to equilibrium here. Okay, and so that's a little bit of, and that sector rotation, has been moving basically over into, let's say, risk off types of sectors. Okay. So when you get these risk off sectors, they, like Staples and a few others. Now with our members this Sunday, we'll go through more detail of some of these. But you can see here in this ratio chart right here, this is a ratio of technology to the SPYs. And technology has led the way all year long. But you can see the big drop off that we've had here. And we're testing right now this key area. It's just a big area. So I don't expect too much more selling in tech. But if we get it, then we're going to see money kind of flow out of tech into the staples market, or in the staples ETF. And this is the staples sector to the spider, right? And it's just been going down all year. Staples has been a huge underperformer because these are more value stocks, and companies or investors have just not been holding them for the past 4 or 5 years. This, though, it could reach a bottom. You're seeing some bullish divergences here and move up. So that tells me we're kind of getting that. And now look at TLT. You can see here, TLT is underperforming, which means interest rates are moving a lot higher because TLT goes in the direction of the bond market, which is opposite interest rates. Okay, so if we were to look at treasuries and just look at the corporate bond market or the U.S. bond market, look at this low here. I mean, we were up in this area here, and up in this area, if you guys recall, I was saying you should be picking up puts in TLT because the move favors the downside. There is no bullish divergences here. So, can this go lower? Yeah. If I were to back it out a little bit, remember what I was saying? I was saying down around this trend line here, around the low 130s. I don't think we're going to get there very quickly, but the bond market tends to move in fast sound bites over the course of a month. You can see this very fast move here, and then it kind of goes into a sideways pattern and kind of settles in for a long time. Then it moves into a fast pattern, and then we can expect a sideways movement again as markets settle in. So if you're not in the bond trade, it's hard to jump in and catch it, right? Psychologically, it's hard to jump in and catch it. But I've been telling our members up in this area here, TLT puts is a way to go, or short the bond market, right? And you can also pick up some puts in the equity market, or bear call spreads or bear put spreads, and just kind of stay a little bit short the markets as we have some of these little bit of pullbacks here. Okay. Now, if we come back and let's return and let's look at the other one that was kind of scaring me just a little bit, is the Russell futures. Look at the Russell. That's an ugly chart, guys. All right. Now, this is small cap and mid cap. This is clearly a move down. Look at how it hit perfectly on the 200, and it found support there. But this is not a pretty chart for the rut. Now, this could be a sign of things to come. We're going to know here fairly soon going into earnings, but you can see the Russell, was one of the late ones making new all-time highs, because if we go back to January, right, just like the Dow, right, we had January high right there. We really didn't make a new high there. So we had one here and then here. So we've made just 2 new highs since January, unlike about the 5 or 6 new highs with NASDAQ. Only 1 new high with the Dow. So NASDAQ, the Russell really started picking up here. But now we're at this key level here. Let me just draw it out here for you. So let me just kind of clear the screen and show you again. If I were to kind of just bracket in here, what we're looking at, it's right in that area right there. Okay, remember, it's not a point in time or a price down to the penny. Some people like to say, yeah, look at how accurate technical analysis is, because it'll go right to the penny. But that's not how markets move, especially with the algos firing out today. Markets always overcorrect, both to the upside and to the downside. Hopefully you guys know that by now. But we look at these ranges right here. So that's the range that we're in. Should we break that? We're now starting to get escape velocity away from the 200 EMA, but in the wrong direction. And we can find ourselves very quickly back at break even for the year in the Russell. And if we get down here, I promise you the other markets are going to be equally as unsettled. Okay. You can see this area right here. It's the lowest volume area here, which also tends to be the support area, which is right at the support area right here. All right, and then we've got a lot of volume sitting right here. If we got down here, I would be a buyer of the Russell right here, or maybe selling some puts underneath here, or doing some skewed butterflies here to the upside, because I don't think we'll go much lower than that. But I don't think we're going to get there. Okay, I think we're going to be like the others, stuck in a range until we get through Q3 earnings and just kind of see how things shape themselves out. But this is not a pretty chart, folks. Now, if we look at the Dow Jones Transports, this also was a precursor. As I was telling our members, we made, like the Dow, this was back in January, we made 1 new high here in the transports, just like the Dow. This started falling before the Dow. The Dow kind of followed this a little bit later. This made a new high before the Dow. And now we're down below the 50 EMA. So I would expect somewhere down in the 200 EMA to hold us up a little bit. Okay. If we start to break down these technical patterns, then we're going to pick up a little bit more short deltas in the overall position structures that we have. Maybe some long gamma in there as well, long volatility. Now, we've got a trade going on in volatility, which we've seen over a 95% success rate in. For those of you that are not members, I highly encourage you to come in and check it out, because it's a great way to go. For those of you that are members, we'll go through it, because now we've got our allocation model working, and we're in on our B leg on this thing. So non-members, you ought to come in and check it out. It's a lot of fun. Now, so that's kind of where we're sitting across the vol market. And speaking of vol, let's take a look at the VIX. VIX finished the week at 1482. Okay, and you can see. Let me just kind of move these zones out here just a little bit so that you guys can see. I consider that zone 1. I consider this zone 2. We color our. I basically color my areas here. It also helps for our members. It also helps look at the zone that you're in as far as the strategies that you're going to use. And you can see Black Swan, where I've got it black up here like this. So these are kind of how we're shaping out right now. And if I kind of zoom in on this, you can see here that the vol is sitting right on the borderline between green and yellow. Okay. And we don't get into the slightly pink, not quite solid red, once we get over the 20 vol in the VIX, the spot price. And then we start getting into the red here once we get over 30. Okay. Now you can see back over here, as I showed before, when we get into we actually had that when XIV capitulated and actually liquidated, we were in the yellow or the red for a long period of time. I mean, we started it in February and we didn't get out till May. So you had 1, 2, 3, 3.5, 4 months well elevated volatility. So when you get these vol spikes like this, the markets get spooked very easy. Okay. And that spooky nature keeps the volatility elevated, and we shift some of our option strategies once we get in this area. And then since May, we've had a few vol spikes, but we've been basically in the green zone. And now we're looking to get another spike. If we move back up here, then that's when we start coming down and testing the 200 EMA, and we start seeing a little bit more ugliness in the markets. I'm not expecting that, but then again, should we get it, we know how to trade it. Okay. But that's just a little bit about where we're sitting in the vol market right now. Now, if we come over, and I showed you treasuries, but let me show you the 10-year interest rate. If we look at the 10-year interest rate, all right, this is the highs that we've had. Let me put it on a weekly chart here. This is the high for the year, but it's the high going back quite some time. Okay. If I were to just zoom out, and this is a weekly chart here, but if I were to zoom out on this thing, you can see here that just right like that, we haven't had these highs since coming back to 2011, right down here. Okay. So we've got that, and then we've got this wider support zone right in this area here that takes us up to the 4% area. I just don't see us getting there. I think the Feds, and you can see a little bit of divergence starting to set up here. You can see that long spike higher right there. Remember, markets always overcorrect both up and down. We may see some softening in the interest rate, but remember, this is what happened back in January. But what happened in January, which is what spooked the markets, it was the first time interest rates started moving up, and it moved up very quick, right? That was the January, February debacle. But it went from about 2.4% over it was making a run to the 3% level. Then from this run here to this run here, the markets actually moved higher because it was fairly controlled. But now you can see that huge fast move up like that. So when you have these tall, narrow boxes, which shows the range and time and distance of a move and interest rates, these kind of things tend to upset the market a lot more. And when you have a wider move like this, the markets can digest it a little bit better. So if we see this thing kind of settle in a little bit, you'll see the market settle down. You'll see vol come back in. But if it continues higher, then we're going to see some more pitfalls. Then you'll see the projected probabilities of future Fed rate hikes come in a little bit, right? Because Jerome Power Ranger Powell doesn't really want to just spook the markets and start getting them down. He wants interest rates to go up, but in a very gradual pace, because he's used that word gradual over and over and over again. So this is kind of where we're watching on the interest rates, because it'll be a good clue as to what's going to happen with everything else. Okay. So now if we come down and let's take a look at gold. Gold did move up a little bit, but let me tell you guys something. Gold, in my mind, let's come back to a daily. I'm not ready to go long gold. As I've told our members, and I think I did here last Sunday as well, look at that movement right there, right? We sat at a level before we broke, and we actually broke down. We came down, we came back up, and we just stayed there, right? So now look at this one right here. It's the exact same pattern. We came down, we came back up, and now we've stayed there. So this pattern is a little bit longer in duration, right, than this pattern right here, but it's still nonetheless. And the reason why this is longer is the bulls just don't want to give it up. There's some gold bugs out there that just, it's kind of like the crypto nuts that always think it's going to go back up to 20K. Now it may, but not with my money, not right now. So I think the near term for gold is probably more likely down than up. But if we do get up in this area, I'll be willing to short gold more than long. The only thing that would change my mind is just a change in the technical nature of the pattern. With our members, I'll go through some of the nature of what that is. But look at the 50 EMA here and here. The last time we stayed above the 50 EMA was back in April of this year. But look at it. We've hit it here, right? We hit it there. We hit it there. And now we hit it here, here, and then here 4 days. And the 50 EMA, which did have a downward vector, is now flat, right? And the 200 EMA still has a downward vector, but it's turning flat. So that just suggests gold is going to watch interest rates and inflation. Remember, when inflation is going through the roof, gold loves it. But lower inflation, higher interest rates, it's not a cocktail mix that the gold market necessarily likes, at least for the short term. I do believe gold is going to move back up again, but now's not the time for gold. Members, stand by. I'll tell you when, but we're not there. Oil. Now, oil is moving up, not for market dynamics, but just because of what Trump is working with Iran on, with the fuel embargo. My play in the oil market is, as I've been telling all of our members, is the spread between Brent and crude. We're just porpoising higher here, and now oil is off the 2018 highs of 76.90. We've got this trend line that we broke, we regained it, and we've got an upward vector both in the 50 and the 200. Can it go higher? Yes, but I think WTI is a little bit weaker than Brent, right? So if we look at Brent oil, here's Brent futures here, it's a little bit stronger. And if we look at the let's look at the yield or the spread between the two. If we look at Brent over crude, look at that spread here. For those of you that follow me or follow my weekly updates, I was getting long, and I was telling our members, this is an area where you want to go long, because Brent is going to outpace WTI going into the fuel embargo. Now, I think if it gets up at this level, Morgan Stanley is forecasting it can go up to about 15. And I've seen it up to 22. Up in this area up here, we're going to be happy pirates, because what we're going to want to do, here's my pirate face, right? We're going to want to short it, because the spread, it does not maintain a high spread between Brent and WTI for a long period of time. It just doesn't. And you can do it, for those of you using Thinkorswim, you can do it in the Thinkorswim platform. So we'll talk about this in more detail on Sunday, but this is, $1,000 a contract, right, on the spread. And we've gone from 650 up to 982. So that's a little bit over 3.30. That's $3,300 per contract. So 2 or 3 contracts, you'd be up around, $6-7 grand, $8 grand in this thing, and it's $9 grand in this thing real quick. So that is kind of what we're doing. Now over here, guys, our members, we traded it to the downside. And again, it's $1,000 per contract, and it's a good hedge trade. It's a little bit less of a movement during the day than, say, just being long or short any one of the oil contracts, because it's $1,000 a point as well. But this never moves the speed with which oil futures does, up or down. But it's a good, I think, smart way to play it. And what you're playing here is a reduction in world oil inventories, which is Brent, and WTI is less affected. So that's a little bit about what we got going on there. Now, we've got some interesting things going on in the ag market. Soybeans, corn, wheat. I'm not going to go into the details here. Members will spend more time on it. So that's a little bit about where we sit, guys. I wanted to spend a little bit of time on that. Sorry for my voice. Members, I will see you this Sunday evening. But if you're not a member, I'll say it again. I highly encourage you to come in. We got some great opportunities here with the markets that I see over the next year and a half. We're going to see a dynamic shift. And if you're doing the same thing you did over the past 7 years, you better start switching now, because the dynamics will change. And you just need to understand that what strategies worked 7 years ago, or through the past 7 years, is probably said better, is not going to be working as well on a go-forward basis over the next 3 to 5 years. All right, everybody, that's where we're sitting. A little bit long this time, but have a great weekend, folks. Members, I'll see you Sunday evening. Take care, everybody. Ciao.